Somewhere right now, a banker or a director is telling a multimillionaire exactly where to put his money. Now, we weren't invited on that call, you weren't invited on that call, but I was listening anyway. This came from the private banking side of JP Morgan Chase Bank, the part of the bank that only deals with people, with clients sitting on $5 to $10 million or more. Regular people don't get access to this. Now, their wealthiest clients just got told exactly where to put their money right now and where to pull back on. Let's break it down in plain English, because most people will never hear this unless they already have serious ties or serious money sitting with an advisor. First thing they're leaning into is gold. Now, normally people think gold is just what you buy when obviously, you're scared, or when the world just seems to feel like it's unstable. And that's part of it, right? But it's not the whole story right now. Central banks all across the world, around the globe, meaning entire countries, are buying gold to diversify away from holding everything in US dollars. When central banks are stacking gold, it's not panic. That is a long-term positioning move that they are ready for. The bank's target has gold moving up around 25% from where it's at currently sitting right now. Let's put a real number on that. Say somebody put $100,000 into gold today. If that 25% does move and it actually does play out, over the next year, that $100,000 is worth $125,000. That's an extra $25,000, right? $25,000 just from gold sitting there, not doing anything else. The takeaway here is the case for gold, it's still there, even after a recent dip, because the real buyers, the central banks of the world, they have not stopped. The second thing is defense and security stocks. This one makes sense. Once you think about the state of the world, right? The world's getting a little more divided, not less. Countries aren't just trying to save money on trade anymore. They're trying to protect themselves. They're trying to protect energy, supply chains, actual physical security. Now, think about that. What does that actually look like on the ground? Especially over the next few years. It looks like governments building new missile defense systems. Countries spending billions of dollars rebuilding factories to make their own weapons instead of relying on someone else halfway across the world. Nations are racing to build cyber defense the same way they used to race to build tanks. Now, that's not some abstract number. That's entire industries getting rebuilt in real time. We're talking about the companies that build fighter jets, missile systems, military technology, names like Lockheed Martin, RTX, Northrop, the kind of companies that live or die based on how much governments decide to spend on defense. And globally, all of that spending is projected to roughly double over the next decade, heading toward $3.5 trillion by 2030. That's 4 years away from now. 4 years. Defense stocks actually pulled back recently. They dropped double digits. And here's what that budget concern actually means in plain terms. In plain terms, a government can announce it wants to spend a huge amount on defense, but that money has to still get approved piece by piece through the actual legislative process. The same way any government spending has to get approved, has to get voted on and signed off before a single dollar goes out the door. So when people got nervous that some of these massive spending promises might get delayed, watered down, or fought over in that approval process, that's what knocked the stocks down. But the banks seized that pullback as an opportunity to buy in. They don't see it as a warning sign. A takeaway here is a dip in a sector that governments are structurally committed to. They're committed to spending more on for years. That's usually not the same thing as a sector actually falling out of favor. Third thing, and this one surprised even the people on the call, emerging markets, specifically places like Taiwan and Korea. Here's the plain English version. Semiconductors, the tiny chips that that power basically everything now, especially AI, mostly get made in Asia. Okay? As AI demand keeps climbing, those countries have been shipping out more and more chips than ever before. Which means more money coming in for that country. Which means their companies are making more money, more profits, and their stock markets have been booming. They have been taken off because of it. Now, normally you think a more divided, fragmented world would hurt emerging markets, but it's actually doing the opposite. Especially for the ones that are supplying what the rest of the world desperately needs and wants right now. The big takeaway here is it's riskier than just owning a plain US index fund. Sure, we know that. But right now, it's not a blind risk. It's tied to actual demand, and that demand isn't slowing down at all. Now here's where they're pulling back on, and this part matters just as much. Countries like Europe had a good run, but here's what that actually means. Valuations, they went up, which just means that European stocks got more expensive relative to how much money those companies in Europe are actually making. You're basically paying more today for the same earnings you could have bought cheaper a while back. So the deal isn't as good as it used to be. On top of that, Europe is more exposed to the same energy crisis, the same energy price spikes we're all feeling right now. Meaning, they rely more heavily on buying energy from other countries instead of producing much of their own. So when oil and gas prices jump, it hits their economy much harder than it hits ours. So what the banks did is they moved from liking Europe to basically being neutral on it. Software companies, broadly not tech as a whole, right? Specifically software, AI is starting to actually disrupt existing software companies, software business models, the same way it disrupted other industries. That just means you need to be more selective, especially when you're dealing with a lot of money or have a lot of money when you're buying tech. They specifically still like cybersecurity within that space, just not software blindly across the board. In the long end of the bond market, quick plain English on what they even mean or what that even means. A bond is basically you lending your money, your hard-earned dollars to the government or a company, and that company or the government pays you back later with interest. The long end just means that ones that don't pay you back for a very long time, 10, 20, 30 years. Now with inflation expected to stay higher for longer and government spending more, locking your money away for decades right now just does not seem like the right approach. It's considered riskier than it used to be. Basically, they're telling their clients, do not, or we will not tie up all your money for that long right now. They're favoring shorter term instead, where you get your money back sooner and you can reposition if things end up shifting. So cash is king. So here's the real takeaway if you're someone with actual money trying to figure out what to do with your money if you don't have an advisor. The big theme underneath all of this is the world is less stable and it's less predictable than it's been in decades. And that's actually changing where smart, real money is flowing. Money moving toward the actual structural shifts happening right now, things like energy, security, chips, gold as protection, Meanwhile, the places that only worked because the world used to be calmer and more connected, broad Europe, broad software, long-term bonds, they're getting treated with a lot more caution. Now, you don't need millions of dollars to think this way. You just need to understand why the money is moving where it's moving. Instead of trying to guess off a headline or a hot tip, that's basically what big wealthy private banks are doing with their money. Anyways, if you made it to the end of this video, do me a favor, hit that like and subscribe button. It helps this channel grow. Also, it only takes a couple seconds, right? Anyways, appreciate you for watching, and I'll catch you guys on the next video.